My name is Valerie Hughes, I'm CEO of the United Way here locally in Clarksville, Tennessee. And we're just going to give a few minutes to get everybody logged on so that we can get it started. And it looks like we've got a great group on. Do you see that, Steve?
Oh, yes.
David? Yeah.
Great.
So since it looks like we have the bulk of everybody on, you want me to go ahead and get started?
Works for me.
All righty. Well, good morning, all the partner agencies of United Way. I appreciate you all coming on. I also want to thank Stone, Rudolph, and Henry for taking this time to help us stay with policies and compliances. This year is especially important because of all of the COVID money that we've either received or CARES money. It may be a little bit of a challenge during tax time, so we need to make sure that we're calculating and following those regulations. So I'm very grateful they'll be able to take care of those. But before we jump into their part of it, let's go over some fundraising criteria for United Way. Remember that the blackout time is September 1 to October 31st. However, we understand that sometimes you guys have to have a program that time. If an event must fall within the blackout period, there has to be a request and it must be approved 30 days prior to the event, and it has to be written and sent to me and then approved by our board, and you'll get a letter of approval once you get that. And if you fail to comply with that, the monies that you raise will then be taken out of at the end of the year when we do allocate monies. That will be money that you've raised outside of that time. So please know that. If there's any questions, I'm not sure if I'm able to. If anybody gives a question, someone will let me know. And this is all in your contract that you sign when you do your grant with us. It's in the standard agreement form. Y'all all have that. It's part of your grant process. So take the time sometime today or the next couple of days, because we're about to go into that season, to look over it and make sure that you're following those basic criteria that United Way asked so little of you all, so that we can do the fundraising to help you guys as an agency. And part two is our kickoff will be the first week in September. The date it will be held at the airport, and when we get final times and dates, we will let you know. Okay, and I'm going to turn it over to Stone, Rudolph, and Henry. Thank you guys for the time.
All right. Thank you, Valerie. And thank you all for joining us today. Good morning and welcome from Stone, Rudolph, and Henry. We appreciate you all joining us today. Thank you especially to Valerie and United Way for all that they do and have done, and for the meeting last week. It was great to see a lot of y'all. I point to the screen as if you can see me as well, but it's great to see you all last week at the kickoff meeting and be out in public again. As Valerie mentioned, it was certainly a challenging year last year, so we commend you all for, I don't know if surviving is the right word, but for continuing on under some difficult circumstances. I know United Way never took a break, and a lot of businesses had to be shut down, but it made you all even more essential. So we commend you for making that happen, for getting that done when it wasn't easy, even more so than usual. So thank you for all that you do to benefit the community, and for joining us today so we can help you maintain your compliance so that you can continue to provide those services. All right, let me move my slides here. Bear with me. I'm going to be doing double duty, so if I get behind and go back and forth, that'll be that. So we want to focus today on compliance, an important area not many people want to talk about and kind of try and breeze over unless something comes up, but we just want to focus on some things now that things are starting to get back to normal, or the new normal, if you will, for all organizations, including nonprofits. But as Valerie mentioned, there was a lot of moving parts last year, a lot of funds available, and not necessarily with instructions on how exactly to account for or expend those funds. So a lot of moving targets, and we'd like to just stop now and take an hour or so and focus on some of those, make sure we're complying with those, so that way we don't have any issues and we can keep those benefits going out to the clients that desperately need them. All right, so again, we thank United Way for joining us, for helping facilitate this process and helping you all be able to join us today, and for their dedication as well to making sure that they're in compliance and giving you all another opportunity to revisit your processes and procedures and make sure you're in compliance also. A little bit about Stone, Rudolph, and Henry. Most of you probably know us, so I won't spend a lot of time on this. I guess I can introduce myself. My name is David Fitch, CPA here with Stone, Rudolph, and Henry, going on 11 years. I work in both tax and assurance or audit services, so I get to see both the operation side and the tax side. And I think that helps give me a pretty good perspective on how best to help our organizations comply with all the requirements that are thrown at them. And Steve Springer, my associate here, principal at the firm, been with us a little over 20 years, I believe. Try not to date him. He started when he was 12, so you can factor that in accordingly. But he's been with us for 20 years plus, and he also has a lot of nonprofit experience, both heavily involved in nonprofits on boards and treasurer, I know, of at least one organization, as well as, of course, audits and tax returns, and has helped with applications for exemption. You name it, he's probably seen it. So he's on the call as well. We'll be kind of tag teaming today, but we do want this to be as beneficial as it can be for you all. So please interject with any questions, any comments. If you can add a situation you ran into, maybe that relates to what we're talking about, that might shed some light for other organizations, please feel free. We want this to be interactive and helpful, and nobody wants to listen to me talk for an hour. So surely, please go ahead and interject and ask questions as much as you can. I think there's a raise your hand feature and a question and answer if you just want to shoot us either through the Zoom or even by email. When we're done, we'll have our contact information. So please use this to be as much benefit to you as it can be. As far as our firm goes, just touch on that a little bit. We have two locations, one in Clarksville here that I'm located at, and the assurance services are here in Clarksville, and also another location in Brentwood. We have approximately 35 to 40 full-time employees. That we are a full service accounting firm, so we can meet all the needs that our clients have or try to. And we also have an internship program that adds about 10 to 15 or so bodies here in the tax season, and then a few throughout the year. We try and partner with local universities, APSU especially, and also a few in Nashville, to not only gather our interns, but hopefully hire them on full-time. Most of our new hires are from that internship process, which is a way that we try and help give back to the community to help get their careers off on the right foot. But that's enough about us. We didn't come here to hear about us. You want to hear about compliance. So let's talk about nonprofit organizations. I found this quote out there that I thought would help transition into the nonprofit realm and what all you do. So, great things are brought about and burdens are lightened through the efforts of many hands anxiously engaged in a good cause. I think that would probably sum up each one of you and your organization and what you do, and essentially meeting a need that might not be met by anybody else, but is certainly a need. You know, governments, businesses, even individuals, religious organizations, hopefully we all give to some extent, either monetarily or with our time, but there's still a portion of the population that might not get that need met. And we saw last year, the government tried to help significantly with stimulus checks and unemployment compensation and some paycheck protection programs, things like that. The government, I think, did a pretty good job trying to help, but we all know how the government works. It takes time. You know, the first stimulus check came out pretty quick back in April. The second one didn't come out till January. So that 9-month gap, and even that one I think was $600 a piece, which would barely even make rent for an individual. You know, there's a lot of gap there. So I know that you guys as nonprofits ran into a lot of opportunities to help individuals. And that's really the goal, is to meet that need that nobody else is meeting. But in order to do that, in order to have that confidence from donors and whatnot, we have to be in compliance with some laws and regulations. And so that's what we'll focus on today. And with that, I'll turn it over to Steve. Where's that compliance start?
Well, it starts at the top. And so I think we're going to talk for a moment about board responsibilities, and just give you just a quick overview and a reminder. And as David said, I'm Steve Springer. I'm one of the principals with the firm, and he was kind about how old I was. I've been with the firm 20 years, but there's another 19 years of experience on top of that. So working with firms in Nashville and in the banking industry. So David, thank you for the introduction. Board responsibilities, three main areas. One is strategic. You guys are the ones who set the plan. You identify the mission, you create the plan, you hire the CEO, set the CEO's compensation, those types of things. You really provide the tone, if you will, for the whole organization. So that's part of your strategic responsibility. You also have a legal responsibility, and under the law, it says you're to exercise due care in all things that you do, conduct affairs prudently, be loyal to your organization, and by that I mean do what's best for the organization rather than what's best for yourself or other related parties. And then obedience, and that's staying true to to the mission that you guys have created, to your procedures and things that you put in place, is being sure that you make sure those are carried out properly. And then fiduciary, protecting the property, the financial assets, the reputation of your organization. Something that's unique about nonprofits is that no one owns them, you know, as opposed to a business, a for-profit entity. Someone owns it, and someone is looking for a return on their investment. Nonprofits are unique in that no one owns them. Therefore, you know, that's why you are so highly regulated in some senses, is because the IRS says if we're going to give those donors a tax deduction, then the IRS and other regulators want to make sure that the money that's being given is being given and spent on the mission of the organization that has been approved by the IRS. So, so you have a real responsibility, and it's a serious responsibility. I know David's going to talk more later about an IRS audit that we ran into this last year. And I will tell you, in nearly 40 years of practice, that's the first time I've ever had a nonprofit organization have a full compliance audit. And it was interesting. Let me tell you, it was interesting. I've had partial audits before where they come in and look at one or two particular issues. But I've never had a full audit. And so we'll talk more about that. But there are some very specific things that we want to encourage you to take a look at as a result of going through that experience. And one of those, as we're talking about the board here, is just be a serious board. You know, this is not just an honorary title. This is a serious responsibility. So looking at some of those obligations there, be informed, be active. Make sure you're independent of and not dominated by the employees of the organization. And then keep minutes. By all means, keep minutes of your deliberations on issues, the decisions that you reach, and why you reach those decisions. That's very important, as we have certainly learned going through that process this last year. All right, Dave, if you'll turn that. All right. Regulators, you know, I asked some questions here. Why is it important that you be regulated? Well, probably one of the most important things is because people are donating money to your organization, and the government wants to make sure that if people are giving their money, that it's being spent for the right purposes. It's not being abused. Who's responsible for compliance? Well, that certainly starts with the board, and it is also the responsibility of management. And then ultimately, everyone in the organization has a hand in that. It starts at the top, but it goes all the way to every level of your organization. People need to be aware of what's required and why that's necessary. Then I asked the question, can you name all your regulators? You may not be able to, but we're going to talk through a lot of them today. We've broken them down into three big categories of federal, state, and then local. And so we'll talk about several of those as we go through this presentation. But as we're going through, you may think of some others that may come into play. So David, I'm going to turn it back to you to get started on some of those discussions.
Okay, thank you, Steve. So as we kind of mentioned earlier, really the objective today is to just point out a few things that we've ran into and some things that we've seen, and hopefully identify some issues. And the IRS, going through that audit, one thing that was nice is they really wanted to work with the organization. They told us from the beginning the object wasn't to shut them down with this information documentation request, is what they called it. There ended up being 6 of them. They call it, of course, an examination, audit, whatever you prefer to use there. But they really wanted to just make sure that that organization was complying. And if maybe they weren't in the beginning, but as long as they are now and are fixing the things, moving that going forward, they were very forgiving. And really, when it was all said and done, it took about 1.5 years, I think, to go through the whole thing. But when it was all said and done, there was really no change, but there were a lot of changes made to the organization to help comply. So the objective today isn't to make you feel bad. The objective is hopefully to identify some things that maybe you are doing, or maybe you can do a little bit better. So that way, in case, heaven forbid, you were to get selected to be looked at for particular items, that you have that documentation available. It's a painless process and you can keep going on business as usual. So as Steve mentioned, there's really three main levels of compliance: the federal, state, and the local. We'll start like he did at the top with the organization, with the board. We'll start at the top with the federal compliance, and that's really where we even have to get started for a nonprofit organization. So the first thing that you have to do, of course, I won't spend a lot of time on this because I presume most of you are already nonprofit organizations, so you've been through the process, but just in case you're involved with another organization that might be getting started or thinking about it, I'll just kind of hit the highlights on these. First thing you have to do is get that employee identification number, your EIN, by filing an SS4. And a lot of people actually stop here, especially smaller organizations, and think because they selected non-for-profit corporation that they're done and now they're a nonprofit. It's not quite that simple. The IRS will be looking for an 1120 until you get granted a determination letter. You don't get that determination letter until you file a 1023. And that's a pretty significant documentation required to complete that form. And there's actually two types. There's a 1023 and a 1023-EZ. And the 1023-EZ is it's only 4 pages, a little simpler, mostly checking boxes. I'm saying that you've done certain things. And if you file the full form 1023, that's where you actually have to document all those things, such as your articles of incorporation, your bylaws, your mission, your board of directors. I believe even some financial projections as well when you get started goes in that form 1023, but most of that's not required in the 1023-EZ. The idea behind that is to sort of smooth out and streamline the process for smaller organizations. So there's a requirement to be, I believe it's $50,000 or less in gross receipts in order to be able to apply with the 1023-EZ. So it's not for everybody. Generally, it's for new organizations or for smaller organizations that have been operating and meet that threshold. So the reason we were told that 1023-EZ application and the 990 subsequently was selected for audit was because they grew so fast. The organization that was audited, which is a good problem to have, but if you file a 1023-EZ, and I think within 2 or 3 years, they'd already had $1 million in gross receipts. So they were well over the $50,000 they anticipated, which again is a good thing. They were able to provide a lot of benefits to the community. But the IRS kind of said, okay, well, let's make sure, since you're obviously affecting a lot of individuals and getting a lot of donations, that we are complying with what's required of a nonprofit organization. You check the boxes, but the first thing they asked for, like Steve said, was documentation of those minutes and a bunch of things we'll get into as we go. But keep in mind, if you do get that 1023-EZ, get that determination letter, that you still have to perform all the same requirements as any other nonprofit organization, and you're held to the same standard. And so with that is that 990, that information return, that is what you have to file if you get that determination letter as a nonprofit. Of course, it's exempt from tax, so you're not doing it to pay tax, but it is an informational return, both for the IRS as well as for the public. It is available to the public. Generally, I think GuideStar posts them for free. If you go online, you can get most nonprofit organizations 990s for the last few years. But also, if we'll look at it later, but if requested, you're supposed to be able to provide that to donors or individuals that have an interest in your organization. And the main purpose, like Steve said, is for that confidence for those donors as well as regulators, that the transparency is there for your operations. And it's a 1-year tax return. Also has some comparative information, but depending on which form you can file, there's 3 forms, depends on how much information gets disclosed. So the 990N is really easy, less than $50,000 gross receipts or average of the 3 previous years, just an electronic postcard, 1-pager that certifies that you had less than $50,000, has the principal officer on there, and you're done. Now, it's an important thing to keep in mind, because Steve can correct me if I'm wrong, but I believe if you don't file one for 3 years, you lose your tax exempt status and you have to go through the process again. So even though you might think, oh, we didn't have any activity, so there's nothing to file, there is something to file, just to keep that, just to let the IRS know that that is the case. You have minimal activity and they will honor it. You can file it late, if you will. If you're 2 years into it, you can file it for those 2 years. But once you get past the 3-year mark, you have to essentially start over. So just keep that in mind if you're involved with an organization, or if your organization is in that situation. Especially with last year, a lot of organizations couldn't make it during that 1 year or so, that things were shut down and donations and whatnot were hard to come by. So just keep that in mind. There's that filing requirement even if you have no activity. Then the next step up is the 990-EZ, which is similar to that 1023-EZ. It's a 4-page form. If you have less than $200,000 of gross receipts or $500,000 of assets, And it's a lot simpler, again, kind of like the 1023 easy, checking boxes primarily that you've done the things you're supposed to. You don't have any other large assets outstanding, anything like that. So it's a little bit easier, a little simpler to prepare. And you have the full 990. That's a 12-page form with a lot of schedules that go behind it. I know it goes all the way through Schedule R. So, you know what, 17, 18, 19 or so schedules that can go along with it. We prepared some 990s that are 40, 50, 60 pages. So a lot of information potentially, depending on the size of your organization and the activities that gets disclosed to the public and also to, of course, the IRS, and that they do look at them, as we found out, and you have to make sure that you're maintaining compliance and also doing the things that you're saying that you're doing on that 990. All right, now as Steve mentioned, let's go ahead and talk a little bit about some of the issues we ran into with that audit. The first one, as you think of a nonprofit organization, they started at the very basic beginning mission, like the first paragraph of the articles of organization or bylaws for your organization, whichever it is, and made sure that they were staying true to their mission. I think it's like the first sentence of your purpose clause generally states that your purpose is either to further charitable, education, religion, maybe scientific purposes, but that the purpose of that is for the public benefit rather than private. So one of the main focuses of this particular audit was on that private benefit potential. And it was a fairly unique organization in the way that they operated, but the IRS wanted to make sure, and it wasn't abundantly clear when you looked at the 990, that there's public benefit and not just personal. So let's look at some examples here, because probably most of us don't use inurement in our typical vocabulary, at least I don't. So it really relates to, again, obtaining some private benefit, some private interest in a nonprofit organization when the whole purpose is for the public rather than a private individual to benefit. So some examples here include excessive compensation paid to employees or benefits paid to family members. When I think of this, I think of, you know, someone on a board that might have a 28-year-old finishing up their bachelor's degree, still at home, and you really want to get out there at work, so you say, hey, go work at this nonprofit for $75,000 a year, and they don't hardly do anything. Well, that is certainly not benefiting the public at all, and they're obtaining a private benefit from doing so. So that's kind of what the IRS is after there. Steering business to a for-profit company. So maybe your nonprofit organization that you're a board member on is doing a fundraiser, or maybe there needs some renovations, and you own a construction company, and you choose them to perform that work. Now, is that wrong? Not necessarily, but like Steve said, we have to maintain that independence, and we as CPAs have to do so in both fact and appearance. So even though it might be you might give them a discount and you might do great work, there needs to be some documentation there that maybe you looked at 2 or 3 other quotes and they beat it by 10%. And maybe when the board voted on it, the person that's also owns that for-profit company did not vote. They recused themselves. So it's not to say you can't use an organization that you're familiar with or work with or have some ownership in, but we need to document that it was fair, that it was equitable, and that there wasn't any personal gain that was unfair to anybody else because of that. And the last one that I'd say probably comes up more than others, and might be even a more easy example to understand, is if you have, say, a volunteer, like a parent. I'll use a concession stand as an example. You got a kid on the football team, you volunteered in the concession stand, and all the profits go to the football team. Well, if that profit also is designated specifically for your child, and say they get $50 savings in dues or fees or equipment, then really you're essentially working for that $50. You're really acting more as an employee than as a volunteer. So again, does that mean you can't volunteer for your children's benefit at all? Not necessarily. In discussions with the IRS, review of the rules, as long as the public is benefiting by it. So for example, if you're volunteering at a football game for your son who might be on the football team, as long as the proceeds go to the entire football team or to the entire school, to the general account, and aren't designated specifically for that individual, and the public rather than your private investment is benefiting from it, then that is okay. But it can be a fine line, and like Steve said, if we don't have that documentation, it can be even more difficult to convince an IRS auditor. So keep that in mind. You're there as a nonprofit organization for the public. I believe we had a question there. And so just make sure even if you are dealing with something that might be related to your to a private benefit, that it is documented. Do we have a question there, Dalen, or was that just a? Nope, that was a sound. I don't know. Maybe I just heard that, so I apologize. Let's continue. The next thing we ran into, and this probably hits on quite a few organizations that are present here, is grants and scholarships, which, you know, as we heard in that purpose clause, we can be a nonprofit organization for educational purposes. So you might be furthering someone's career by allowing them to obtain the education they need by awarding a grant or a scholarship. And, you know, is there anything wrong with that? No, not necessarily. But in order to make sure we aren't having any private interest, any private benefit from that, we have to have a documented process on who receives those scholarships and grants and for how much. And the IRS really focused on having a process in place with some metrics, and then having a designated body that makes that decision. So it's not just the director of the organization, it's not just the director of the board, but there's a consensus. And then again, there's some objective reason as to why we're picking those people. So if you're on the board, does that mean your son can't get one who's about to go to college, or your nephew or your niece or whoever? Not necessarily, but again, we need to recuse ourselves from voting on that, and then make sure they line up with whatever metrics are in place. So if it's based on need, you might have, you know, a household income of, you know, less the poverty level, or 150% of the poverty level, whatever that may be. Or if it's based on merit, you know, you have at least a 3.5 GPA or whatever the case may be. Or if you set a guideline for the amount of the scholarship, maybe $1,000 to $5,000. And all of those things fall into place when that individual is selected, and it can be easily documented that there was no private benefit there. There was no favoritism shown. It was just they qualified and the board, you know, approved it. So really the IRS was getting after that compliance aspect, documenting the independence, making sure no one is benefiting from it personally. The public has an opportunity to get or apply for those grants and scholarships, and that there's no favoritism involved in the decision. So the main thing that we took from that, there's probably a couple of things. One, they actually had us add the grant decision-making process to their articles of organization, or their bylaws. And that was kind of interesting. We had to file it with the state and get it back. But it brought up another point that Steve and I had discussed yesterday. You know, a lot of times as nonprofit organizations, I know United Way has seen this, your mission, or maybe the way you carry out that mission, is a changing thing. It's always changing. You might see a different service that you can provide that a client needs that might not be part of your initial mission. Like Steve had mentioned an example yesterday, you know, say you operate a homeless shelter, and you also start providing daycare because you realize that people that are homeless have children that can't go to work because they have to watch their children. So you might provide some daycare services. Well, that's a whole different aspect of a nonprofit service. So you have to make sure you're complying with some new rules. I know the gym I go to at Crunch Fitness, when my wife first joined, one of the main things was that they had childcare, so she could go and we have 3 children, so they could watch them, and that would give her an opportunity. But they found out about compliance pretty quick, and Tennessee came in and shut down the childcare aspect of it because they hadn't applied as a childcare, they just applied as a business. And so it took them about a month to weed through that process before they could open up the doors again. So in order to provide that service, you know, we just got to make sure that we're keeping our focus on our mission, that it's approved, and that it, again, just furthers the benefit of the public. I did look into what happens if you do change your mission. A couple different things. If it really coincides with your mission, it's just a different arm, then it's probably not as big of a deal. You can get a private letter ruling from the IRS where you essentially give them the scenario of the program you're considering, and they can give you a private letter saying, yes, that's fine, keep going. Or if you change your mission altogether, then you have to essentially request another determination letter based on the new scenario. But something to keep in mind. I know that comes up, especially with some of the challenges that we ran into last year with COVID and whatnot. Things are constantly changing, and the services that you provide might not line up with your initial mission, still accomplishing a need and helping meet a need, but might not be what you initially set out to do. So just keep all that in mind. All right, the next slide, I believe, is everyone's favorite. Yes, record maintenance, documentation. You know, everything is super easy. You write it all down when it happens. You never have 2 things going on at once. It's great. If only, right? We wish that was the case, but we know, just as business owners and just individuals, that's not how life works. So it can be difficult sometimes to maintain those records. But here's a few things to focus on that the IRS had mentioned that we see also with our audits. The governing body definitely needs to keep minutes. That's just that was one of the first things they asked for. And not only is that good for the organization, but it also takes some of the pressure / responsibility off of the director. If the governing body, documents their decision to purchase from XYZ company that might have a relationship that you're familiar with, that takes some of the responsibility off you, and is also there for purposes of the IRS to approve that you had a reason for that decision. It's documented. So the way we think of things when we're auditing is if there's no documentation, it didn't happen. I mean, I know you might say it did, and we might have a pretty good idea that it may have happened, maybe it didn't, but if you document it, it's great for us and for auditors to just fall back on that, to have that as evidence. The next thing, internal control document. Most of you might be scratching your head thinking internal control document, or maybe you made one several years ago. I know TCA, Tennessee Code, required that from government organizations, I believe about 3 years ago now, to have an internal control document. And it might still be sitting there from when you made it 5 years ago. It's a good idea to revisit that. It's kind of a living thing, as we've seen over the last year especially, but even the last few years, the way technology is advancing, so much of operations are changing as far as how we're accepting donations. I mean, there's so many options now, and cash is almost the last option there is, and probably the last one I use. I love Venmo and Square and Cash App. All that makes it real easy to just send 15, 20 bucks. You add it on to your receipt, 20 bucks here, there. Just a lot of different ways that organizations receive money, and probably very few of them are through cash nowadays, and most likely policies and procedures that you have address primarily cash. So it's a good idea to revisit that internal control document and your policies and procedures for that purpose. But also, we saw last year, sometimes people can have to be quarantined for 2 weeks, or maybe they can't work at all for 6 months. Well, what happens, especially if you're in a small organization, there's only 3 or 4 of you. We need to keep things moving, and you might not know what all that person was doing. But if you have a nice internal control document, or really policies and procedures for each job position that you have, it can help keep that continuity going and keep the services going to the clients in need. Conflict of interest policy, another thing the IRS asked for. Another thing that's really good to have, and most organizations probably do have it when they got set up, but again, it might be filed somewhere under 18 other things and might not be visible, and you might not have no idea what's even on that. We recommend, of course, looking at it at least annually. We have a lot of clients that give it out to their board members once a year, and then they sign a statement saying they acknowledged it. You can put that in a file, and that way you have documentation that it's still being reviewed, it's still in place, and then hopefully as things come up, they'll document even in the minutes. I see a lot of minutes that people recuse themselves from voting because they have a personal interest. So again, just that documentation factor is huge. And then I actually had a question, or another associate of mine did yesterday, about donor information. Like, what all do we need to keep from that? Well, a couple things. The main thing, of course, is the name, their address, the amount they contributed, and the date they contributed. That's a really good start. If you have all that information, that's pretty good. There's a couple of reasons it comes in handy. One is on the 990, your tax return. There is a schedule. If you exceed a certain threshold, generally it's $5,000 for contributors. You have to disclose that information on that schedule. And also, it's a really good tool to have if you need a donation and you've seen who's donated. You can reach out to them again, thank them, because from the IRS standpoint, you're required to send out a letter if I believe it's over $250 in a year that has donated to your organization. You're supposed to send them a letter acknowledging their contribution, and that way they have a record for tax purposes that they donated to your organization. So it's really a 2 or 3-fold reason to get that information, but it is necessary to keep track of that. And also for donees, so those grants and scholarships, that's another schedule that goes along with the 990 that you have to disclose who all you gave the grants to, who all you gave scholarships to, the name, address, and amounts that you gave to them. So it's needed for the 990, but also good to have in case, hopefully you're not audited, but in case that comes up, you have, again, that documentation. All right, and now as we were talking about donors, I'll hit on charitable giving a little bit. Tax Cuts and Job Act, I think that was in 2017, went into place basically in 2018, seems like ages ago, and about 300 acts ago by the Congress. They've been passing acts left and right with all the different funding options that they've put out there. But one thing to know from that, again, is the threshold that you could donate and deduct from your adjusted gross income increase from 50% to 60%, and that is still in place. 2 other items that we wanted to hit on as far as charitable giving goes, things to maybe remind your donors about, or maybe the situation just comes up in conversation and you can let your donors know about. A big one is for non-cash donations, things, investment property or investments like brokerage accounts, things like that. If an individual donates that to an organization, and let's use land as an example, especially around here, say they purchased $20,000 a piece of property, 10 years ago. Of course, now it's worth about 5 million. It seems like in Clarksville, but let's just say it's 50,000 or 100. Let's say at 100,000, make it nice and even. So there's an $80,000 gap there, right? They paid 20, and now it's worth 80. Well, if they sold that to the public, if they sold it pretty much on any website or whatever, they'd have to recognize a gain of $80,000, and that would go on their tax return. However, if they donate that to a nonprofit organization, they'd have to get an appraisal to verify that $100,000 value. But if they do that, they can recognize the donation of $100,000 without recognizing any of the gain. So they benefit, the nonprofit organization assumingly benefits if it would help them. They don't need a random piece of property, but if it's close to their where they plan to do business or to meet a need for a client or a potential program or something, then everybody can win in that scenario. So something to keep in the back of your mind. Then also qualified charitable distributions, another handy tool for donors to save some money from a tax standpoint. If they donate directly from their retirement account, they can just reduce their taxable income by that amount. Now, you might remember about 3 years ago, the Tax Cuts and Job Act also increased the standard deduction for individuals on their tax return. It about doubled. So if you were married, it went from around $12,500 to $24,000, which made it very difficult to itemize. And part of that itemizing aspect was donations or charitable contributions. So say if you want to give $10,000 to an organization, you're not going to be able to really itemize, so it won't benefit you from a tax standpoint. Hopefully that's not the only reason they're giving, but it's a nice benefit that comes along with it. So if you use this vehicle here, this qualified charitable distribution, it'll reduce your taxable income by that amount directly, and you can still take the standard deduction, and the nonprofit organization still gets their $10,000. And again, everybody wins except for maybe the IRS, which we're okay with that. So things to keep in mind from a donor standpoint. If you have any questions on that, feel free to refer them to us, or if you're going through that process, we'd be happy to answer any questions along the way. I mentioned earlier, as far as compliance, there is some public disclosure that is required for nonprofit organizations. It's not really as intensive as I thought. I know some people have mentioned or had the idea that they can walk in and ask for anything, anytime, as far as compensation or bank statements, et cetera. But really, all that the IRS requires a nonprofit organization to disclose is that their last 3 years tax returns, I believe, the 990, and their application for exemption, the 1023. So that's all that has to be available, and you can put that on your website, which would meet that requirement, or you can have it available if someone were to come in. If they submit a written request, you have 30 days to fulfill that, or if they ask in person, you should have it ready and available for that.
Hey, David,
Yes,
some organizations may have been in existence so long that they may not even know where their Form 1023 is located.
That is true.
And so you can get a copy from the IRS. I'm just letting you know that, and really you should. If you don't have those two documents together somewhere, your 1023, that was your original application for tax exemption, and then your recent 990 tax returns. If you don't have those readily accessible, you need to get a copy of that 1023, put it in a safe place. But I would have a public file. So if someone did walk in the door, you know that those two things that you're required to give them are right there and ready to hand out. So each year I would keep a file that included those two items. So I think that's pretty important.
Absolutely. All right, moving on here. As far as some things that Valerie had mentioned came out this past year, there was several opportunities that the government provided for businesses and nonprofits alike to get some assistance during the shutdowns and everything else that happened last year. So we'll hit on those a little bit. These get kind of specific with the organization and with your accountant or CPA or whoever, so I won't go into a lot of detail, but I did want to touch on these. One thing that's not on this slide that I'll mention before I forget is the Paycheck Protection Program. I know that was available to a lot of organizations, and they were able to obtain that, which is great. It was very helpful, and was forgiven for the vast majority of it as long as it was used on the acceptable expenses. So that process now, most people I think have probably been forgiven for the first PPP loan if they got that, or maybe in the process of the second PPP. But the big thing with that, again, was that documentation on what you use those funds for. And then when it got forgiven, one question we had quite a bit was, well, what do we recognize it as? Is that considered taxable income? Is it not? It's not. It is considered I think it's contribution from a government agency is what that ends up equating to on the 990. So something to keep an eye out for when you're looking at your 990, when you're reviewing it, is that's where that'll go there on the statement of revenue. There's a line for, I think it's line 1E, and it'll go on the government grant. So it's considered income from them, but it's not, of course, taxable or anything. But that was a very helpful tool. There's also the economic injury disaster loan. If you didn't already get that, it's still available through the end of the year. I think the max loan is $500,000, payable up to 30 years. And this one is a loan. It's not going to be forgiven that we're aware of, so it will have to get paid back. And for nonprofit organizations, it's only 2.75% interest on that. So keep that in the back of your mind if you run into some significant issues and need some cash flow. There's also some credit still available. These keep getting extended. I think they were initially supposed to expire in April. And I know the employee retention credit and I believe the sick and family leave credit are available at least through September 30th at this point. So again, if your employee has to take off because they either have COVID or quarantine because they might have it, or if they're taking care of a family member that does have it, you are able to pay them and then essentially get reimbursed when you file your payroll tax returns. It's just a credit against your liability for taxes, and it is refundable. So it's an important benefit for your employees as well as an organization to know that you're going to get compensated for it or forgiven that amount. So that way it's not killing you to keep everybody employed, but keeps them employed when they can come back. So those are still available and for the foreseeable future. So keep those in the back of your mind as well. And with that, I'll turn it over to Steve. Oh, go ahead.
Yeah, thank you, David. I would just say on that last slide, that's one of those that you want to put a big star on. That's an action point probably for all of you to check with your CEOs, to go back to your board meeting and talk about whether or not your organization might qualify for those three types of assistance. We've gone back and amended a lot of payroll returns for clients that did not take advantage of it last year. And after we informed them that they probably were eligible, they were able to do that and get tons of money back. So it may or may not apply to you, but it's certainly worth taking the time to investigate. So I would put a star on that page. All right, so we're going to take a look at some other federal issues here, and then I'm going to transition into talking about some state issues. I think we have about 17 minutes left, so I'm going to go through this pretty briefly. This is an employee versus independent contractor. We get this question a lot. Do I have to treat someone as an employee versus can I let them be an independent contractor? Well, it's not a matter of picking and choosing. They are or they're not. And there are criteria that the IRS has for that. They really come down to the amount of control that you have over an individual and the work that they perform. I'll give you a quick example. Maybe you guys want to hire a grant writer. All right, you want someone to help you, and let's say it's maybe even not intended to be a permanent position. Maybe it's going to be for a few months. They're going to help you write some grants. One of the key questions you have to ask on the front end of this is whether or not that person performs that same type of work for other people, for other organizations. Do they hold themselves out to be self-employed, and do they provide that service to other organizations? If they do, it's a strong argument for them being an independent contractor. If they don't, then even though they're only temporary, they're probably an employee, and which means that you would have to withhold taxes, include them on your quarterly filings, give them a W-2 form, and then you as the organization would pay half of their Social Security and Medicare, and that's often the big issue. So I'll just say be very careful with that. Ask your payroll company, ask your tax advisor if you have any questions at all. But it's not just a matter of what do I want to do. It's a matter of what the rules are, and there can be some gray areas. So it's just important to talk to some folks before you make those decisions if you have any questions about whether or not someone is an employee. All right, so from the payroll tax standpoint, whether you prepare your payroll internally, or whether you use software, or whether you use a payroll company, you still have all these filings. The I-9 form, that's one of those forms you get on the front end when you hire someone to verify their eligibility to work. You're determining whether they are an American citizen, or whether they are an immigrant, or someone that's in the country temporarily with a work visa. You have to determine that criteria and document it for each employee. The W-4 form is where your employee tells you essentially how much federal tax they want withheld from their payroll. So that's obviously important. It needs to be in your documentation. And most employers will get that every year, just to allow employees the opportunity to change that if they want to. And then the 941 reports, that's the quarterly payroll tax return that every employer files. And that's basically, as you go through each quarter, you are paying the employees, you're withholding taxes, you're remitting the taxes. And then on a quarterly basis, you reconcile all that activity and make sure that the tax that should have been withheld and the tax that should have been paid in was. And if it's not, then you true it up there at the end of each quarter. And then at the end of the year, we have some other filings, the Form 940. That's the federal unemployment tax form, and that does not apply to all nonprofits. Some it does, some it doesn't. Some are exempt. So if you don't know whether or not you are, you need to find out. And we'll be glad to help you answer those questions. But also, as an employer, you have to remit W-2 forms, give those to each of your employees. And then the W-3 form really is just sort of a summary sheet, if you will, that summarizes all of your W-2 forms. And then you transmit all that to the Social Security Administration or the IRS, as the case may be. So those are all in filings that every employer has, just making you aware of those. Also, something that's a little different, if you do have those folks who are independent contractors, they're not an employee, but they provided services for you during the year, then you have to give 1099 forms. Now, in the past, most of those 1099 forms have been called a 1099 miscellaneous, MISC. They changed the form this year. There's now a 1099 NEC, standing for non-employee compensation. And so, if someone provides $600 or more of services to your organization during the year, and they're not an employee, you have to give them this 1099 NEC. The 1099 miscellaneous still exists, but it's primarily used for when you're paying rent to a landlord. So you would use it in that situation. And then the 1096 form, again, is kind of like a summary form. You total up all your 1099 forms, put the totals on the 1096, and you transmit all of that to the IRS. All right, now let's talk for a little bit about state issues. And we started off with income tax there. Obviously, Tennessee does not have an income tax on wages. Up until the end of last year, there was a state income tax on interest, certain types of interest, and then dividends, but that has gone away now. So Tennessee truly has no income tax for individuals at all. But some of our border counties and states do, like Kentucky, for example. You might ask the question, well, what's my responsibility as a Tennessee employer or someone who lives in Kentucky? You have absolutely no responsibility for withholding Kentucky taxes. Now, you may choose to do that voluntarily and remit that on their behalf, and that's certainly a great accommodation for your employee, but you technically are not required to do that. It would strictly be voluntary if you withhold Kentucky tax for your employees. But there are some other state issues. Workers' compensation, for example. When does that come into play? Well, if you have 5 or more employees, then your organization will be required to provide workers' comp insurance. And in some industries like construction, coal mining, those are more dangerous in particular. Only 1 employee. If you have 1 employee, you have to have workers' comp. Other folks that have to be included, if they meet the definition of an employee, are family members, part-time employees, corporate officers. But again, only if they meet the definition of an employee, and that being they receive wages or salary. Next page, please. All right. The other issue that comes into play besides workers' comp is unemployment, state unemployment. Okay. And so a couple things here. If it comes down to how many employees you have as a tax exempt organization, the first bullet says inclusion, and it says employees of a religious, charitable, educational, or other organization, provided the organization is exempt under IRS Code Section 501c3 and had 4 or more employees. That's the key right there. If you have 4 or more employees receiving wages and worked in some portion of a day in each of 20 different calendar weeks during a year. So you had employees during 20 weeks out of a 52-week year, then you are subject to state unemployment. In those, we call it SUTA, but state unemployment. Now, what's excluded is if you have fewer than 4. So fewer than 4 employees receiving wages, then you're not subject to the state's unemployment insurance program. All right, next page. Sales tax. This is so important. And why? Well, again, we said Tennessee does not have a state income tax. So therefore, the primary sources of revenue for the state of Tennessee are sales tax. And it's so interesting because, you know, when these sales tax laws were written, say 100 years ago, there are many products that we have today that didn't even exist then. Even the things that we see more now than anything are technology, different types of technology services and things that we get over the internet, streaming and this and that. They didn't exist years ago. And so now the Tennessee continues to rewrite the law each year to expand to include other taxable products and services. But what does it apply to? The selling, leasing, or renting of tangible personal property. Well, what is that? Well, tangible personal property is anything that's not real property or anything that's not intellectual property. Real property, obviously, being real estate. So there's no sales tax on real estate. Intellectual property, that being things like copyrights, patents, contracts. For the most part, you don't have sales tax on those issues. But if it's tangible, if it's my phone, if it's a pencil, my desk, my computer, all those types of things that you may use in your organization, sales tax would apply. Now, we're really concerned here about things that you're selling. And I realize that, you know, you think, well, yeah, we sell T-shirts, we sell this, we sell that, but we're a nonprofit. That doesn't apply to us. Well, not necessarily. Something you've got to be careful about. Looking at that third point there, for most organizations, if your gross sales of tangible personal property are $400 or more a month or $4,800 a year, then you are probably subject to the sales tax laws and should be collecting and remitting sales tax. Now, there are some exemptions. But number 2 there in particular, Tennessee likes to call that the Girl Scout cookie law. And what that is, it says that if you conduct a sale of whatever it might be, and you don't have the sales period more than twice a year, and the sales period is for 30 days or less. So Girl Scout cookies is a great example. So let's say Girl Scouts sell cookies in February, I think it's somewhere around that time, and they don't go more than 30 days. And then if they sold them again later in the year, in October or whatever, and they don't go more than 30 days, then they don't have to collect sales tax on those. But if they had longer sales periods or more frequent, more than twice a year, then they would be subject to collecting remitting sales tax. So be very careful about this. Tennessee is very serious when it comes to sales tax because that's their primary source of revenue. All right, now exemptions. When you go to buy goods that are used in your nonprofit, you can use an exemption form when you go to the store to purchase those items. But there are some rules when it comes to that, and I think we may have a slide on the next page. There we go. And this is what the law says. The authorization for exemption is limited to sales made directly to the reference organization. The exemption certificate may not be used for sales made to individuals paying with personal checks or personal debit or credit card, even if the individual is a representative or employee of the organization, and he or she will be reimbursed for the purchase. So what that means is you tell one of your employees, hey, would you mind running over to XYZ store and picking up these supplies? And if you'll just use your personal credit card, we'll reimburse you for that. And you give them the exemption certificate for the organization. They take it down to the store. Technically, that store is not supposed to grant you the exemption. Now, we all know there are some who do. And I can tell you one Walmart may give you the exemption and one up the street may not. We've seen that happen. But it's really incumbent on the stores to enforce that. But technically, you're not supposed to be using that exemption certificate without either using a company check or a company credit card or debit card. Using that, having employees use their personal cards or personal checks is really against the state law. So just be careful about that. Next slide. Games of chance. All right, we all employ different ways of fundraising, and sometimes, I'll use the example of a raffle. That's a game of chance. A game of chance is any kind of game or event where people pay money or anything of value. They put it in up front in order for a chance to win even more. All right, they stand to lose what they have put in. So within the last 2 weeks, I've received emails from clients where they were advertising some events that they had coming up. And I had to get in these long discussions with these clients about, you do realize what you're describing, and you just put it out there in the public that this is a game of chance. And so have you registered for that? And they don't know what I'm talking about. So that's a real problem. 2 weeks ago, when this first situation came up, I went on the state website to see which organizations in Montgomery County have registered to conduct a game of chance this year. There was one. Austin Peay State University is the only organization in Montgomery County that may conduct a game of chance at all for the whole next year. And so be very careful if you start planning fundraisers that involve chance, like raffles and things of that nature. There's a very specific process you must go through. You have to apply with the Division of Charitable Solicitations and Gaming. And then it's a long drawn out process. I won't go through it in the interest of time. Let's go ahead and move through the slides there. Business tax. Here's something to think about. If your organization is subject to sales tax, for example, you're probably subject to business tax. And that's something to think about. Typically for nonprofits, you might be exempt, you probably are exempt on your services, you typically are, but you may not be exempt on all your personal property sales. So be aware of that. In addition to sales tax, you may actually owe the state, county, local folks a business tax as well. Let's change the page. All right. David, were you going to take it up from there?
Yes, sir. All right, so in order to maintain compliance with the state as well, you have some annual reporting obligations. I won't spend a lot of time on these either because most of you are probably already aware of these, but just in case, when you first get started, you have to do your annual report, $20, and then from then on, due date is 3 months after year end, which generally is going to be April 1st. There are some initial registration requirements when you get started that have different fees associated with those. As well, on an annual basis, you have to renew your registration for charitable organization, and that's based on your gross revenue. It's moving like a sliding target. The more revenue, the more the fee is for whatever reason. But you can request to be exempt from that charge if you are under $50,000, and that has to be done annually, not just once. So every year, if you request that and you meet that requirement, then you can be exempt from having to pay that registration. You also have to submit a summary of financial activities, and that's due generally 6 months after your year end. So if you're December, that's due June 30th. And then you are able to get a initial extension of 3 months. And that's actually not 3 months. I said 3 months, it's 90 days. We found out last year that it's not 3 months. That would make sense, but it actually turns out to be September 28th, not the 30th, if you're a calendar year end. So keep that in mind. You can get it. Sometimes it's helpful if you have an extension on your 990 because you have to I'll include that as well to just go ahead and extend your summary financial activities obligation. There are some pretty stiff penalties if you are late, so keep up with that, and hopefully your tax preparer will help you keep those things in mind. We do for our clients. And then one other thing, if you submit that summary of financial activities and you have over $500,000 of gross receipts for that year, you have to have an audited financial statement attached to it. And I know that is one of the reasons we do several of our audits, because of meeting that threshold. And that's really a good thing to make sure by the state, at the state level, that all those funds are being accounted for in a way that is appropriate and that the public can maintain that confidence in that organization. But I know it's an expensive requirement for nonprofit organizations, so just keep that in mind. And when you do submit that, that gets attached with that summary of financial activities.
Hey, David, I think that includes both cash and non-cash donations, right? So for example, if you're an organization that receives, let's say, donation of food, and then your organization distributes that out to those in need, then even though that's not cash coming in and hitting your books, that receipt of food, the value of all that has to be considered whether or not you exceed 500,000.
That is correct. Yes, we ran into that situation specifically in the past, so that is something to keep in mind. Lastly, I think this is our last slide here. We're right about at 11 o'clock, a little over, so I'll just hit on it real quick. Property tax, you can be exempt from that. You should be, probably for your principal operation site. But if you were to get a piece of property donated to you, as we mentioned earlier, if someone gives you a piece of property that you maybe plan on using a year or two down the road, maybe aren't using yet for your exempt purpose, try and do something to use it for that purpose, and you can apply for exemption from property tax. I think Steve ran into this before with his church. I think they got some property and they ended up using it as a parking lot until they decided what they were going to do with it, or maybe it still is a parking lot, but it was serving a purpose for the organization, so they were able to get exempt from the property tax, because we want to use the funds as best we can and not have to pay, of course, any more taxes than we have to.
Sure.
All right, I think that takes us to our last slide. And apologize, I might have got a little long-winded there, so we had to move through a few of those maybe quicker than usual, but most of those I think we've hit on in the past, so hopefully nothing new there for most of y'all. But does anybody have any questions, thoughts, comments, anything that came up that they thought, hey, I might need to look into that?
You can send us a question with that chat feature that it's at the bottom. It's at the bottom of my screen. I assume it's at the bottom of yours, and probably even the Q&A. I'm not sure how all that works, but typically on these webinars we use the chat feature. Does anyone have a question?
Not all at once.
Okay.
Well, if you do need any more information, if you think of something, 10 minutes from now, or maybe just didn't want to ask it, feel free. My email is on there. Steve's email is on there. You can email Valerie. If you can't think of it, you don't have our contact information handy, we'd be happy to research it for you and get you an answer as best we can. And with that, I think we'll send everybody on their way. Thank you, Valerie, again, for the opportunity to present with you guys and with your partner organizations.
Thank you so much, guys.
Thank
Thank you
you.
for the great information.